Hey, I'm Gene Goldman. Here's a look at the week ahead for the week of October 9th. Let's talk about bond yields. As you see here this year, using the 10-year as an example, we've seen bond yields jump from 3.9% to 4.8%. But with the Fed being aggressive and potential consumer spending concerns like student loan repayments, like dwindling savings, you would think yields would not rise as much and maybe even fall. So let's discuss the rise in bond yields and what we're watching this week in terms of what could impact these yields. Keep in mind, higher yields tend to pressure stocks because higher yields leads to higher borrowing costs, also slows the economy down. Also, higher yields tend to hurt valuations. So if the economy is stronger, generally speaking, bond yields rise, and vice versa if the economy is weaker. Let me show you an example. If you look at this chart here, the Citi Economic Surprise Index, and that's that dark line on this chart, every time data comes in above expectations, the line moves higher. Every time data comes in below expectations, the line moves lower. If you look at that red circle, you can see that recent data has been moving lower. Basically, the data has been weaker. But that lighter line is a 10-year Treasury yield. So even though we've seen weaker data, the 10-year Treasury yield has moved higher. The question is, why is it moving higher? This next chart explains the one primary reason why. The budget deficit is increasing. We are seeing less revenues, that's that light blue line, and also more expenses, more Social Security outlays, higher interest payments. To finance debt, to finance this budget deficit, the government has to issue more debt, like more treasury bonds. And we all know bond prices move inversely to yield. Therefore, more supply into the market equals lower prices equals higher yields. Other reasons yields have moved higher: quantitative tightening. Basically, the Fed is not buying as much treasuries as they have in the past. And also foreign demand has slowed down a bit. So looking to this week, what could potentially drive yields? Wednesday, we get the meeting minutes from the Fed's last meeting. If you remember that meeting, the message was higher for longer. So we'll get more insight in terms of were all members of the Fed on board and how strong was the debate for higher for longer. On Thursday, we get the Consumer Price Index, CPI. Consensus expects a slowdown from August due to energy prices slowing, a pullback in used car prices. If this data comes in higher than expected, this likely sends yields even higher. Thanks for listening. For more information, please follow us on Twitter at Cetera IM, and see you next week.